the markets hated ASML's earnings. So if you're a normal person and if you were to just look at this earnings itself, they beat EPS by quite a fair bit, they beat revenue by quite a fair bit as well, and they beat gross margins by 2%. So the majority of you would have guessed that the stock was going to go up, maybe 5-10%. But instead, ASML is down 9% today, and it is currently trading at 29 times earnings. And after this earnings, the stock is actually trading at around 26 times earnings at this price. So for ASML, this is why the stock is selling off. Let's see what the CEO has to say about the results.
25%, which is in line with our backlog. Going into 2026, there the fundamentals of our AI customer remain strong, and we are still preparing for growth. However, as we discussed last time, the level of uncertainty is increasing, mostly due to macroeconomic and geopolitics consideration. And that includes, of course, tariff.
So what Fauquier said earlier was that ASML is preparing for growth. So there are two interpretations of that. Number one is that ASML is not expecting any growth next year. Or number two, ASML is not sure about what the growth will be next year. So it depends on how you interpret it. Wall Street is probably interpreting it as the former. So besides that, ASML also didn't give any 2026 guidance. And the reason for your lack of guidance is because of your tariffs. So if you looked at the Wall Street Journal article yesterday on the H20 chips, Wall Street Journal actually said that the Commerce Department has prepared harsher restrictions on China, including limits on equipment needed to make semiconductor in case trade relations sour. So this will in part affect ASML. ASML has around 25% of their revenue coming in from China. And so if you're to have export restrictions being placed on ASML, then likely it will affect their revenues as well. And that's why the company didn't give any 2026 guidance, because it is impossible for you to predict what will happen next year. So besides that, the company is also facing multiple headwinds. So the first one is that Samsung is cutting their capex by around half this year, and Intel is doing so as well. Intel dropped their capex by around 10%. So there's concentration risk when it comes to owning ASML, because you have 20% of their revenues coming from Samsung, you have around 5% coming in from Intel. So this will easily be around a 6 to 7% haircut for ASML if it's not made up by another company. And luckily this year, TSM is actually increasing their capex by around 40%. So that more or less makes up the revenue loss by Samsung as well as Intel. ASML this year is projecting around 15% growth in their net sales, meaning to say 15% revenue growth. And you can easily expect a 20 to 30% EPS growth for this company, accounting for the buybacks and the margin expansion. So for ASML, a significant factor that affects their earnings in a particular quarter is the timing itself. So for ASML, the machines cost millions and millions of dollars, and the changes and the delays in the shipment time could affect their revenue in one single quarter. So imagine ASML's machines, they go for around $200 to $300 million. So if this machine is delayed one quarter, let's say it's realized the next quarter, then that would be a $200 million reduction in their revenue for one particular quarter. And that could be why ASML's Q3 revenue guide is a lot lesser than expected. But I don't see any issue with this. As what Chris Hohn said previously, the predictability of your cash flow is not as important as it seems. So for ASML, regardless of when they receive the money, they will still receive it. Whether or not it is earlier or later, they will still have to get that money from their customers. And so I don't see any problem with this revenue guide coming down, unless there's a long-term cyclical downturn that is coming for your semiconductor industry. But the AI growth is still strong. You're seeing companies like TSMC having earnings and revenue of upwards of 30%. So ASML will likely ride on that wave as well. So Wall Street swinging on this is highly irrational in my opinion. Yes, the Q3 revenue guide was slightly lesser than expected, but you need to understand that ASML is a business that is highly affected by timing. So the company is not giving out guidance because number one, the company doesn't even know if they can ship the machines in 2026 because of Trump and his trade policies and the relationships with China. So that could be a headwind for the business in the future as well. Growth has probably been put forward as well. So for ASML, they've been beating their revenue and their earnings guidance for the past few quarters. And that is probably why the company is not giving out 2026 guidance yet, because they don't want to give extremely high guidance just for them to miss it. And lastly, it's still too early for them to give out guidance for 2026. So for ASML, the 2030 guidance is still intact. So they said this quarter that they're maintaining their 2030 guidance. And that 2030 guidance was modeled by the wafer demand that they're projecting in 2030. So regardless of whether Samsung, Intel, or TSMC eventually cuts their spending on ASML machines, the wafer demand will still be there, meaning to say companies, probably other companies, will still have to buy over this machine to fulfill that demand. And so for ASML, the 2030 guidance is independent of Samsung or Intel capex cut. And so I don't see any material impact on ASML's guidance in 2030, despite all this capex cut by all these different companies, because you still will have to fulfill that demand that the entire world needs. So for ASML, the amazing portion of the business is actually your installed base portion. So this is the segment of the business that is not really talked about on Wall Street, but it is an incredible business. Why? Because it is a 100% retention rate, and the company's installed base portion is actually growing by around 14-15% CAGR over the past few years. In fact, over the past 6 years, as you can see here, it has gone up by around 22% CAGR, and they're expecting around 14% CAGR in the years ahead. So for this installed base portion, it is incredibly predictable, highly recurring revenue coming into the business, and as they continue growing this portion of the business, as this portion becomes a larger chunk of the entire revenue, it will lead to ASML becoming an even higher quality business than it is today. So for the company, besides the installed base portion being amazing, the company is also trading at a historical low in terms of its valuation. So the company has never traded at a below 26 times earnings over the past few years, apart from in 2018 when we had the Trump tariffs. So the company now is trading at a 26 times earnings, and I think for a quality business like ASML, it definitely deserves that valuation. I think a fair value for ASML is around the 30 times earnings, given the monopoly and the growth that the company currently has. So for ASML, I think at a 26 times earnings, you're paying a more than reasonable price for the company, and that's why I think ASML today is providing a decent opportunity. So for ASML, besides that, they are also buying back a lot of shares. So they introduced a share buyback program in 2022, and currently around 50% of that is completed. And so that is around $6 billion left, which is 2.4% of the entire market cap in euro. So if they complete this buyback program this year, then you can see upwards of 2.4% boost in terms of the EPS. So for this company, in summary, ASML is a high quality business that will become a beneficiary of AI in the long term with their growing installed base. Because companies like TSMC, like Micron, they will have to continually buy all these lithography machines to keep up with the demand, and when they keep their machines in their fab, that leads to even more recurring revenue for ASML. So it is one of the highest quality businesses out there, although it could be disrupted by your China innovation risk. And so I'll be continuing to hold this company. This company is probably a top 10 in terms of the business quality. So for now, I'm holding on to this company. The next portion that I'll be talking about is Google. So Google over the past few days has seen a lot of momentum. In fact, the stock is up quite a fair bit over the past few days. So for Google, you're seeing a lot of analyst price targets coming up. So the analysts are increasing their price targets. And this is what you typically see when a stock has momentum behind it. So for Google, the AI overviews have been amazing. This is purely anecdotal. I think AI overviews has been extremely helpful when it comes to searching for things on Google. And so if the company continually innovating to stay ahead of AI, I think this company's fair value is a lot higher than it is today. So for Google, I'm currently holding on to this one. For Google, the sentiments always follow the price. So at the top over here, everyone was talking about how Google will become the biggest AI company in the world. And when the stock dropped all the way to around $140, you were seeing articles left, right, and center about how Google is going to be removed by the DOJ, how Google was going to be overtaken by ChatGPT. And currently now, Google is on this recovery phase, and we're seeing headlines and stories, as well as investor sentiment changing as well. So what this shows is that sentiments always follow the price. When the sentiments are bad, you should be buying the stock, not the other way around. And Google is a prime example of this. Next portion, I'll be talking about the PPI results as well as the rate cuts. So the PPI came out yesterday and it was lesser than expected, signaling that inflation is easing already. So the PPI month over month actually came out at 0%, whereas the forecasted value was at around 0.2%. So this is showing that Trump's tariffs had no impact on the inflation in the country itself. And for Jerome Powell and Trump is actively trying to push out Jerome Powell. So this article over here has said that Trump has drafted a letter to fire Jerome Powell. He asked Republicans if he should send it. So although the PPI result and the CPI result has shown that Jerome Powell should have probably cut rates, I think Jerome Powell has done a decent job in manufacturing this soft landing. So if Trump fires him, there will be a lot of turbulence ahead in the market. In fact, yesterday when this news article came out, the stock market dropped by around 1%. So I don't think Trump will be able to remove Powell anytime soon. He will likely serve his term, but if he ever does that, then you can expect a lot of volatility in the markets ahead. Last portion, I'll be talking about some questions left in the comments. So the first one, it says, what do you think about Chris Hohn's European holdings like Aena, Calnex, Vinci, Airbus, and Safran? So for Safran, it is similar to its GE holding. It's an aerospace and defense company. For Safran, around 50% of the business is actually recurring, so it's their service and maintenance portion of the business. And for Safran, I think similar to GE, Chris Hohn was spot on with these two companies. and it's been rewarded quite massively over the past few years. As for Aena and Vinci, these two companies, they hold airports, and so they're similar to your classic tollgate businesses, just in the physical form. I think for these two companies, they are highly predictable businesses. As for Calnex, it is a company that leases out your cell towers. It is similar to American Towers in the US. I think it is a highly predictable business as well, but it lacks the growth that it needs to be a high quality compounding machine. Next question is Hayes, with much uncertainty and overvalued markets now, despite strong fundamentals in a lot of the stocks that you have talked about on this channel, what do you do if you had funds? Would you enter? So I currently have around 30% cash, but I'm actively looking for opportunities in the market. I think there are decent opportunities in the market right now, like ASML today, as well as some other companies like Multi, like MSCI, like Copart. All these companies, they're providing decent opportunities now. I'm still tracking a lot of them, including Copart. And so there will always be places for you to park your money into, or even money market funds as well if you're looking for your 4%, 5% yield. I hope you guys have found this one useful and invest safe.